What's up, Louis? It's Guys here. Hope all of you are doing great today. I'm super excited to share this video with you, and I can't stress enough how important this topic is going to be. I want to take the time and talk about two things today. And if you are someone that's new in the investment world, or if you are just starting out, this video will help you tremendously. And the first thing that I want to talk about is a tax-free savings account. You've probably heard of a tax-free savings account, and this is such a powerful tool to use as an investor. Not only as an investment vehicle, but a general saving tool as well. So what I'm going to do is I'm going to share a few advantages of using a tax-free savings account. So for those of you that don't know much about tax-free savings accounts, it's basically what the name says. It's a savings account that is tax-free. So the tax-free portion is for capital gains, dividends, and even interest received. So with that said, another thing that we need to know about a tax-free savings account is that we have a yearly as well as a lifetime contribution limit. Currently, the yearly contribution limit is 36,000 Rand, which equals to 3,000 Rand a month. And your lifetime contribution limit is currently 500,000 Rand. So this just means that we can't invest more than that specific limit. So the advantages of a tax-free savings account is so huge, and it's definitely something that you as an investor should consider. The first advantage is, of course, that it is tax-free. This just basically means that if I invested 36,000 Rand in my tax-free savings account, I don't have to pay tax on any capital gains, any dividends received, or any interest income. And this is huge because we want to minimize the tax that we pay, and this ultimately helps us to generate better returns and minimize our actual expenses. The next thing is tax-free savings accounts has huge growth potential. If we invest our yearly limit every year until we reach our lifetime limit, compound interest will do its thing and your money will grow tremendously. With that said, again, all of our capital gains, dividends, and interest income will then be tax-free. Another advantage is the flexibility of a tax-free savings account. You can deposit money and withdraw money without even giving notice. It's such a good tool to use if you want to save money in an account, again, tax-free, and maybe you need some of that money later on in the year. The last advantage that I want to talk about is variety, and this is very important because it will tie in with my next topic that I will explain just now. So variety basically means that we don't have to invest cash into a tax-free savings account. We can use cash and buy a ETF, also known as an exchange traded fund. So let's say we invest our cash portion into a tax-free savings account with a bank like Standard Bank. They will probably give you an interest rate on your cash within that tax-free savings account of about 3%. And that's pretty low, and we won't necessarily grow our money too fast when we use this strategy. This isn't necessarily the wrong strategy for everyone, but this is definitely not something that I personally follow. So with all that said, the next thing that I want to talk about is exchange traded funds, also known as ETFs. An exchange traded fund is basically a hybrid investment vehicle that can hold stocks, bonds, and mutual funds together. So instead of using assets like cash, we can use assets like stocks and mutual funds. An exchange traded fund is simply put a basket of investments instead of using one specific investment. There's huge advantages when investing in ETFs, and the first thing is the low cost. Investment costs is something that's really important and definitely something that we need to account for from the beginning of our investment journey. With an ETF, they talk about the total expense ratio. This is just the amount of expenses that you need to pay when owning that specific ETF. If we invest in an active fund, let's say a company like Old Mutual has a financial advisor and we invest our cash with that person, they charge you a yearly expense ratio, and no matter what, if you make or lose money, that company will still be paid. That's basically what the expense ratio is, and it's important to invest in ETFs that has the lowest expense ratio. The next advantage is instant diversification when investing in an ETF. This just means instead of putting all of our eggs in one basket, we are diversifying by investing a bit here and a bit there. The next advantage is liquidity. Again, this ties in so well with my previous topic where I talked about tax-free savings account, and this just means that we can buy and sell ETFs on the open market like any other stock or company. This is great because if we needed to, we can sell that company or we can sell that ETF anytime we want to, and we can buy into that ETF anytime we want to. This gives us the opportunity to constantly reinvest our earned money into that ETF instead of having to wait for a certain time to invest. The next thing is tax efficiency, and this is where everything ties in together. This just basically means that we can invest into an ETF within a tax-free savings account. Most ETFs are allowed to be invested in within a tax-free savings account. This will ultimately provide us as the investors with the most possible growth while paying zero taxes on that growth. So if this all makes sense to you, please give this video a thumbs up and let me know down in the comments if a tax-free savings is something that you utilize with an exchange traded fund. So with all that said, I want to show you guys something very cool, and this is something that I love to show to people when they ask questions about investing in an ETF or using tax-free savings accounts. So I'm going to jump to my screen and I'm going to show you guys what a typical investment would look like if we invested in a tax-free savings account using ETFs. So this is just a compound interest calculator, and this is just going to help us to calculate an estimated return that we can expect if we use these numbers. So for the initial investment, we're not going to use anything. So the purpose of this exercise is to show you guys the amount of money that we can make if we actually invested our yearly limit into our tax-free savings account until we reach our lifetime contribution limit. So like I said previously, our lifetime contribution limit is 500,000 Rand. Let's divide our yearly contribution of 36,000 Rand, and that just equals 13.8, which means we have to invest 36,000 Rand for 13 years and 8 months, let's call it 9 months, to reach our contribution limit. I'm going to use 13 years just to make this easier. So if we invest 3,000 Rand every month, that will equal to 36,000 Rand after 12 months. So in this exercise, we're going to invest 3,000 Rand for 13 years, and we want to type in an estimated interest rate return that we can expect if we invest into an ETF. And this is where it gets very exciting. There's so many different ETFs that we can invest in. It will take me too long to show all of them to you. But what I've done is I opened a tab on Easy Equities, and I just want to show you a few of them. So here it shows us the top performing ETFs. The first one is the Satrix Fini ETF, then it's Satrix Divi ETF. So basically all of them follows a different index, and let's just see, there's stuff like Inclusion and Diversity ETF, Satrix SA Bond ETFs, Satrix Resi ETF. There's just way too much stuff. I wanted to show you guys the most popular ones, and these are probably ETFs that look a bit more familiar, like the Satrix 40 ETF or the Satrix S&P 500. What I wanted to show you guys for this example, I'm going to use the Satrix S&P 500 ETF, and I have a tab open here that shows the average return of the S&P 500 over 100 years. And here we can see that it shows it is 10.49%. So this is insane if we compare this to what a normal tax-free savings account will give us if we invested it with a bank like Standard Bank. So for the purpose of this exercise, I'm just going to put in 10.49%, and we are going to use the annual compound frequency, and I'm going to click on calculate. This will show us a graph with the information that we used here. And here we can see the blue line is the amount of money that we invested, and the red line is the amount of money that we ultimately sit with in the end of that period. So we invested in 30 years, we invested 468,000 Rand, which is our total contributions, and our future value is 912,000 Rand. So this basically means that using this strategy, we doubled our money in 13 years. And the best thing of all is that all of our money that we made, whether it's capital gains, extra dividends that we received, all of that is tax free. This is insane, and it's definitely one of the best things to start with when you are a beginner investor. We can change a few things, and let's say for the 13 years, the average of the S&P 500 is 15%. Just quickly look at the difference that compound interest can make. Again, our contributions is 468,000, and suddenly our future value is 1.2 million Rand. This is insane, and again, all of that is tax-free. So the thing is, the strategy that we want to use with a tax-free savings account and investing in an ETF is known as a dollar cost averaging or rand cost averaging, and this is exactly the example that I showed you guys. So we want to make monthly contributions to our ETFs within our tax-free savings account until we reach our lifetime contribution limit. The dollar cost averaging strategy is a great strategy to minimize risk, and over a long period of time, this will definitely result in great returns. So with that said, guys, I hope that this can help you. If you have any questions, feel free to drop them in the comments below. Subscribe to my channel, like this video, and share it with your friends and family. I'm super stoked to see that I've reached above 1,000 subscribers, and it's very cool to see that people are actually engaging with my videos. So with that said, I'll see you guys in the next one.